Inflation came in at 8.6 today. What that means going into next week for the Fed's FOMC.
The Fed's goal is to target and bring down inflation. How are they going to do that? Coming after asset prices. We already see time and time again, they've saying that they want to slow inflation, and what they're going to do is through demand. And how are they going to slow demand? By killing asset prices. They are most likely going to continue to tighten further and longer than people expect until inflation comes down. And there's no signs of inflation stopping, especially with oil prices remaining to go at all-time highs. Gas at the pump, all-time high. Food is starting to skyrocket, and that is the main components of the actual CPI print. And as that continues to be extremely elevated, I see nothing stopping the Fed from continuously raising rates and continuously starting their QT program. We have already officially started QT, but they have not sold bonds until the 16th. What happens when they start dumping mortgage-backed securities and a bunch of different assets onto the market? Obviously, that's going to increase yields. If yields are going up and the prices are going down, that is going to be very negative on asset classes. What will happen when the Fed's main goal is to drive down asset prices and they have the actual tools to do it? They can raise rates and do QT. I think they are going to get exactly what they want. And with that, we could see asset prices start to come down. So far, the Fed's gotten exactly what they want. They wanted an orderly decline in the market. What we've seen is nothing like COVID or like 2008, because this has been a very, very orderly decline. Today, again, I mean, there's no concerns right now where we're seeing any liquidity events or credit starting to freeze. When we see that, that's when we could start to see a real crash style event. But right now, this is the Fed's wet dream. We are slowly grinding down on the market, and that is most likely going to start to slow demand. But what happens if we do see a situation where there is a liquidity event? It's most likely going to start in the junk debt market, and especially credit. When credit starts to freeze and we see the yield of those just spiraling upwards, that's when there could be a lot of issues and liquidity could be starting to dry up. From there, it would probably go to the bid asks. If the bid asks start to widen, then you won't get filled on your orders. Not if you're one of us retails, but when you're a humongous player and you're trying to sell, when there's no bid, that's when you really start to shit the bed. Think back to the Black Friday crash of like 1987 or something like that. That is where there's just absolutely no bid anywhere. I don't know if we will see a situation like that, but that is an unorderly decline. The Fed would love to see a 30-40% correction from here, but over a 2-year span. They do not want to see a 40% correction in 2 weeks. If we did see that, that's when we could start to see them reversing course, because they have to continuously pump liquidity into the credit market to keep the financial system going.
Josh, my only thing on this front is that I note that this will be the third consecutive time that the Federal Reserve has raised interest rates. And I believe the old phrase is third time in a stumble. The point is that if you look back throughout history, the third time, generally speaking, that the Fed has a consecutive rate hike, the market suddenly realizes, oh my goodness, the Fed's suddenly serious about that. Puts sell pressure or removes some of the bid. I don't know if that will happen this time around. I don't know if it does happen to the extent that it will happen, but I do know that this has been a phenomenon that's appeared in the past. Very curious to see how that plays out.
The 10-year yield is also really starting to build up some steam. We're at 3.165. That is not good going into a time when the Fed's going to start selling bonds into the market. Is the market finally seeing that, oh, maybe the Fed is actually taking this seriously? That the problem arises if we see yields starting to go up at an unorderly manner, because everything relies upon that. Corporate profits right now, I mean, if we go back to a situation where yields are up at 5-6%, almost all of corporate profits, like quite literally like 50 to 100% of corporate profits are going to be evaporated, because these companies are reliant on borrowing at historically low debt. That is going to be very, very bad for obviously stocks, but the economy in general, because what happens when all your profits gets eaten? You raise prices. Or if you can't do that, you take a hit. That's going to be deflationary on potentially having some of these businesses go bust. M2 money supply has plateaued and has actually started to go down a little. We don't see these new dollars creations, especially the stimulus checks have started to dry up. Banks are not lending. It seems like people are just kind of hoarding and waiting for something to happen. Something that I will note is central banks are starting to just load up on gold. They've been doing this for a very long time, but if every single one of the people who can print money and buy whatever they want, if they're all buying gold, I think that is a prudent thing to look at least. I know that I have been slowly building positions in gold and silver, especially the miners. I would love to add more. I am short-term bearish, but I think that they're they're pretty fairly valued right now. But if we do see a situation where credit starts to freeze and people want to hoard to safety, I think we could see a massive bid in the metals. I sure am positioned for it and would like to be further positioned for it in the future.
Yes. Also, one other note about centrals accumulating gold is that they've also been repatriating gold too. So again, look at what they do, not what they say.
What do you guys think the Fed will say in the FOMC meeting this Wednesday?